It has no doubt been a challenging past couple of years in the market, but as we like to say, for investors, it's really important to have a long-term view of real estate, no different than if you invest in public equities. I would say the environment overall for 2026 still remains cautious. Interest rates are still elevated. We've seen some relief. We need to see some more relief. But there is a significant amount of debt that is approaching maturity. And as a result, refinancing continues to remain somewhat challenging. And capital structures, really, that were put in place several years ago, was done during a different environment. Interest rates were lower. Refinancing today may require some additional equity or even some creative capital stack structures in order to make it work. We've talked about this multiple times on prior episodes. But with the last big equity market correction, I'd say that was the dot-com bust. If you invested $100 in, I think this was August or September of 2000, that would have been worth $53. It took a good almost 7.5 years to get back just to your initial $100 investment. More recently, if we go back to February of 2020, the S&P dropped about 33, 34%. So when that happened, long-term investors in equity markets didn't necessarily pull out of the S&P. If they were smart, as we all know, they invested more when the market was significantly devalued. So we have that on one side of the table. The other side of the table is foreclosed property holdings in the U.S. by banks grew as of about 6 months ago, grew by about 30% annually. Regional banks, I think, were really particularly hardest hit. And when you think about today's commercial real estate market, the question really, Ty, isn't whether distress exists, it's where it's hiding. I think, the biggest significant concentration of distress has really quietly been building on a lot of balance sheets for these banks. And when we see this happen, the banks really have three options when they are carrying distressed assets. One is they can sell the note, which is going to clear up their balance sheet. As we all know, that usually is going to require some sort of steep write down. They can operate the asset. Banks are banks, they're not commercial real estate operators, so that's not necessarily an optimal solution. Or they can bring in a capital partner. We typically see option number one as the preferred option in the marketplace. So Ty, taking on the role as an investor, how do you see this environment as an opportunity for operators like Lassiter Capital, and how could that benefit someone like myself as a potential investor?
Yeah, well, we're starting to see, because of a number of the reasons that you just named through, some opportunities in the marketplace again. We've, as I mentioned a minute ago, we've had operators that couldn't face the writing on the wall and they just up and left, or they're looking to get out of deals that they're in and just walk away and be done. They don't have what it takes, to make it through it. They don't have liquidity. They don't have access to capital, and so their capital pool is dried up. And what I say oftentimes is how you change is how you succeed, is something that one of my business coaches taught me a long time ago. And so you've got to be able to pivot, and many people haven't pivoted through this crisis. And so you've got operators that don't have the liquidity needed for assets. And so that's given us an opportunity to step in and bring in our capital sources and start looking at some deals on the marketplace right now, or really deals that are not even hitting the marketplace, that we've had a number of lenders reach out to us and say, hey, look, I've got this deal, this operator needs out. They don't have the capital sources, and so here's a deal that you can step into for the debt, or in many cases, that's how the conversation starts out. But that debt number is negotiable, very negotiable. Let's say that the lender has an asset that operator paid $28 million for, and there's a $20 million loan on the asset, and that asset has been undercapitalized for the last 2 years, and it's gone backwards. And we've had some assets like that in a fund that we couldn't bring in additional capital into that fund, but we could open a different fund and bring capital into. And so the asset's gone backwards, and so it may be worth $20 or $22 million now, and there's a $20 million loan on it, but it's setting at low occupancy, and or a lot of deferred maintenance needs to be done because all the cash flow has been going to try and cover debt service for the time being, and not keep up with maintenance. And so That gives us the opportunity to step in, and first we got to have the liquidity to put capital expenditures into the asset. Fix the units, whatever the maintenance needs are. We've got to address that. But a lender is wanting to get out as best as possible, and so they're looking at that $20 million note that they have that's unperforming, and oftentimes they're looking at $14-15 million. In one circumstance, we had a $21 million loan, and the lender was looking for a $14 million payoff, and in another instance, we've seen $17-18 million loan with $14 million payoff, and so those loans become negotiable. So that buys you additional equity. And I always talk about, those 4 keys to wealth as it pertains to investing. And number 1 is equity. Getting an asset at a discount. Well, how do you go about doing that? And so there's a number of ways to do that, but one of those ways may be negotiating with the lender for a DPO on a loan, and that lender to stay in. You come in as the savior on the asset with some new capital. You let the lender know, hey, we can take care of the value add that's needed. Here's what we think the property can get to, but we're not going to take over for a loan that is at 100% of face value. We're going to negotiate that down to 75% of face value. And so we immediately get 25% equity there. And then, we're looking for those markets that have appreciation. And so once we've stepped in, we've gotten that DPO handled, we've brought in the equity needed to run value add to the asset, then we can start addressing what needs to be done to get to positive cash flow. And then obviously, as you go through that entire exercise, there's the tax advantages that come along with it. And so, there's going to be a really short window of opportunity here, 6 to maybe 12 months, where lenders are going to be looking to really get these assets off their balance sheet and or get them to performing again. And part of that equation is discounting some of those loans to an operator like ourselves to step in. And so, investors that are wanting to take advantage of this distressed market, there's a short window of opportunity and you need to act quickly. You've got to find an operator that you can get behind and trust and act quickly, because if you sit back watching and waiting for the right opportunity, number 1, lenders aren't bringing new investors opportunities. Okay, some new investor that's deciding they're wanting to get into real estate today, they're not going to have a relationship with the lender that's going to bring them a book of business. If they've gotten in contact with the lender and said, hey, I want to see your balance sheet of what you've got, that lender has already given the deals that they feel confident about to their trusted borrowers. And if they still have something on their balance sheet, it's something that you probably don't want to touch. And so you want to get with an operator that has experience, that has those relationships, in order to get those deals that are in the best position to really take advantage of this distressed market right now and flourish over the next 36 months, like what we saw coming out of 07, 08. If you stepped in late 08, early 09, you really had an opportunity. By 2010, 2011, 2012, you were sitting in a really, really good position. And that's kind of what jump-started myself and my brother's career in real estate.